All right, so I know this is a long weekend, but I really appreciate you guys joining here on that you chose to come into this meeting. You could have been anywhere, enjoying some free time with family, friends, maybe on a trip. But I appreciate you guys chose to spend a couple of hours here, 2.5 hours, 3 hours, to talk about investing. That's what we do, everything related to stock, crypto, etc. So today is going to be little heavy sessions because we have I got two presentations. Generally, try to stick to one, but we had a topics that DoorDash was requested by someone, so I told I'll cover the last week of the month. I try to keep one for doing a deep dive. So gonna do a deep dive on DoorDash. And the other thing was a lot of stuff happening around Ethereum, so I thought I'll cover what's on the Ethereum side. So those two, but also we have the regular stuff that I want to talk about, what's happening on the macro and some crypto news, etc. And also this is the first meeting. Probably it's like the end of the month. August is already end when it comes to when we talk about the stock exchange days. It's already end of a month. So I'll share my portfolio, which I share after every end of a month. So that's are the things on my agenda. All right, let's get started. Anything else you guys have on your mind? Ravi says it was by me, a dash. Okay, cool. So yes, we're gonna cover DoorDash today. We'll deep dive into what I see in DoorDash, and then you can make your own decision. Cool. All right, so let's get started. As always, anything that we discuss here is only for education, and please don't consider it as a financial or a tax advice. Yes, so I always want to start with some, food for our mind. So I finished one book recently. The book name is The Wealth Ladder. It's by a gentleman called Nick Majuli. I had read his first book, which was Always Keep Buying or Just Keep Buying. And I like the book, little basic one, but really set your thought process. So when I got my hand on his second book, The Wealth Ladder, this I really liked. So I did post some of my thoughts around on that on Twitter. So let's go through that. A quick summary of what this book entails. Right. The first book name was Just Keep Buying. So this is a few of my thoughts. First of all, it talks about various wealth levels. Again, the way this book is a little different from a lot of other investment books that you read. It doesn't tell you about the how to invest, what to invest, etc. There are 100 other books, but it basically talks about in terms of how to think about wealth, even when you're spending, or sometimes you just don't want to spend because you think, oh my God, I need to build my wealth, right? But some of the decisions doesn't really matter. You should, if you want to spend, go and spend on it. So, and other thing which is very important is if you have to transition from one level to another, the things that worked in a previous level just won't work it in the next levels, right? And then it talks about what are the things that various people do to move from one level to another, and etc. etc. So let's do a quick review. So there are 6 wealth levels that it talks about. One is level 1, paycheck to paycheck, less than 10K of your net worth. I mean, the numbers are, from a simplicity perspective, it's just a multiplier of 10. It's easy to remember. Level 2 is when you have grocery freedom. You don't have to think twice when you're going to groceries. You can buy what you want to, close to 100K of your net worth. Level 3, restaurant freedom. Level 4, when you move into upper middle class and you have a travel freedom, right? You will still not be able to travel private, right? But you'll still be able to go on a coach and travel to the places that you want to. Level 5, when you have a house freedom, right? It's like up to 10 million to $100 million. And level 6, wherever impact freedom means you're able to change the world through your actions. Then they talk about income, wealth, and spending. while your income pays for a necessity, your wealth pays for your upgrades, right? One other thing talks about, like, assuming your wealth grows by 3.7% annually, you could spend about 0.01% of your wealth each day and maintain the same net worth, right? So, and in fact, I use this. We went to a restaurant. It was a little expensive restaurant, and my wife was surprised why I splurged so, some money on a $25 for an ice cream. And I was like, no, we can afford it because I just finished the book. I'm like, come on, it's like less than 0.01% of a net worth. I think we can afford that. $25 for an ice cream. It was a gelato ice cream. It was a good restaurant, so you have to pay up for it. But I thought, don't worry about it. It changed a little bit thinking process and what you can afford and what you cannot afford. Other thing talks about is level 4, even if there are two people in the same level, depending on where you are in your life, you will or will not be able to spend some stuff, right? Like a 65-year-old retiree with 1 million nest egg can't spend the money like a employed 35-year-old with 1 million of investment portfolio, right? This talks about career and wealth progression, right? Getting a second job, doing some extra hours on your regular job, it makes sense if you're moving from, let's say, ladder 1 to ladder 2, or maybe ladder 2 to ladder 3, right? Get some bonus in your job, put in extra hours, suck up to your boss. But once you reach level 4, those things just won't work, right? And look at level 4 is moving from upper middle class to level 5, right? Moving from 1 million to 10 million into 10 to 100 million. Putting a few extra hours won't work. Tutoring over the weekend to make some extra money, not going to help. Babysitting to get some side income, not going to help you to move from level 4 to level 5. And stuff like this, like hit you on your head like a brick, saying, hey, I've been trying to do the same stuff. It's not working anymore. Yes, because you're at a different level. So things that he talked about, which I really liked, was you need to have a career pivot. Maybe find a different level of a job. Maybe go and get an upskill, right? Find a different kind of a work. That's the only way you can have or maybe start a new business. Or if you can't start a business, then own a business, right? And this is where I went through without knowing the wealth ladder concept. What I went through my own journey was I need to start owning businesses. It means I need to start focusing on investing. I don't want to start my own business to have operational headaches, but I want to own the best businesses. And hey, the other way to own the businesses is you invest and become a business owner in the company, right? Either you start your business or you own a business through equity partnerships. So then there is also talks about leverage for wealth creation. I think this came from Naval Ravikant. So basically there are a few leverages. One is labor. And most of us, we start our journey when we are on a journey of wealth creation is to arbitrage our labor for the capital. We go and spend our labor and we get paid as a salary. That's a very basic level for us to I would say to start our journey. Second is capital, which is using money to increase our wealth. This is where you say use money to create more money, right? It could involve starting a new business. It could involve owning businesses. Third is the content, which has now become very easy, much easier than what it used to be because there were a lot of distribution. So you create a content, share it with others. This is where you get the multiplier effect. You write a novel and then you continue to earn royalty on it. You create viral videos and then you continue to get paid advertising dollars, right? Huge form of leverage. The least leverage is where you have a labor, right? You can't replicate yourself. There is only one of you and there are only 24 hours in a day. So if you are arbitraging your time for a wealth, you have a limit on that one. But when it comes to the content and finally add a code, there's an immense leverage that is available. So start moving and thinking and changing your life. You really want to rise up the ladder. Find out how you can leverage. If you want to move to level 4, level 5, I guess even level 3, level 4, just doing labor is not going to help. There's only 24 hours. And not everyone will be paid. Not everyone can be a lawyer or a doctor where you can get paid $700, $1,000 per hour. Right? You have to move above. Have to do something different. Another topic talks about is asset allocation by wealth level, which clearly tell you what's the difference between what people own at a different wealth levels, right? Level 1, vehicles and the cash make 85% of the people with that asset. Remember, just to remind you, level 1 means less than 10K of net worth. Mostly these will be like recent college grads, just started their jobs, got a student loans to pay. So most of them actually have a negative net worth. By the time you start accumulating, you're on a job and start to pay your debts. And by the time you're debt free, you get your car and have some savings. That's where your vehicles and the cash make up most of our assets. Level 1 to 3 is where we have a homeowners. And true for, I think, most Americans is most of our net worth is actually tied in our homes. The American dream of owning your home, which unfortunately is becoming more and more difficult day by day. Then level 4 and 6 is where it actually separates out, wherein you start to own the assets that produce income for you. Those are the income producing assets, right? Real estate as an investment opportunity, bonds, stocks, private businesses, if you are like a PE firm, or if, these are the assets which will produce income for you while you sleep. If we are still stuck in up to level 1 and 3, we'll be continue work till our till our death, right? Or it doesn't mean that you cannot start at level, you start owning equities, etc. when even if you're on level 3. The idea is the sooner we start accumulating assets that make money while we sleep, the better, and the sooner we will be able to unshackle ourselves from our either job or things that you don't want to do, right? You love doing the stuff, or you'll have a more and more freedom in terms of to do what you want to do, when you want to do, and with whom you want to do. But then you need those assets which will produce income for you. Cash in the savings bank doesn't produce much. Maybe right now it is because the Fed rates are higher, but looking at the trajectory, it doesn't beat inflation. So real growth is negative. If you have a cash sitting in your bank account, you have to have assets that actually generate income for you. And this is where you have a biggest difference between level 4s and level 6. And the other levels are they have their money invested in income producing assets so that they don't have to work 24/7 to make money. The money will make money for them. Right? How do you break out from different levels? Breaking out from level 4 is the hardest one, right? Because whatever has worked till date to bring you to level 4, right? Which means work harder in your job, get some bonuses, show up every day, go above and beyond your stated duty, take more responsibilities. None of them will work if you want to move away from level 4. That is why I think there are some stats which is like people who are in level 4, most of them actually retire and die in level 4 because it's very difficult to move from 4 to 5. A high paying job, decent investment, good savings rate even that cannot break you out of level 5, a level 4 to level 5. What will allow us to move to a different level is business ownership. Either to start a business, join a business, get a huge, at the end of the day, the summary is you need to have an equity in a growing business. Either you start a business, you buy a business, or you take what my favorite way is to take partial equity, little equity through investments into great businesses. I can't buy Google or Meta, but I can buy a little bit of equity investment in Google or Meta. Can't buy 100% of it. Maybe 0.00001% if I own some shares. Additionally, your goal should be to create an asset that you can eventually sell to someone and that it still produce income, right? If you have a business, and this is where I have seen falling into the trap of thinking that we own a business, but if you stop working, that business stops producing income. So the structure might still be a business because you don't have any boss to report to, but actually you don't own a business. It's a solo employee, and you are the employee, because if you stop doing the stuff, income becomes zero, then you actually don't own a business. You still have a job. Just that you don't have a boss doesn't mean you don't have a job. Folks, like if you're running a one-person tutoring center, you don't have any other tutors coming in. You might structure it as an LLC or INC or a C Corp, S Corp, but at the end of the day, it's still a job. Because if you're not are available to teach people, your income drops to zero. It's not a business. Other way around, people say, I own a landscaping business, but I'm the only one. I don't have any other employees. I own a landscaping business. No, you have a landscaping job. The day you fall sick, you're not able to go to a particular project, your income drops to zero. That's not a business. It's a job that you have. So different way of thinking from what a business is and what a job is. And I made the same mistake. You create a C Corp, S Corp means you own a business. Maybe legally, yes. In a IRS terms, yes. But when it comes to your own financial or freedom perspective, no, it's still a job. Okay. Lastly, talk about wealth and happiness, that not all wealth is a financial wealth, right? There are different types of wealth. You have a social wealth, which basically measures how your relationships are with your friends and family, your own mental wealth, your own mental well-being, your self-esteem, physical wealth, which I think we all ignore until our bodies start to give us signals, which is which is the wealth. I think without that, you can't enjoy any other wealth. But by the time I realize it is too late. So sooner we realize it, I think better it would be. Physical and mental health, wealth, and finally the time wealth. The freedom to spend the time the way you want to and with whom you want to. I think, but none of these will make a difference unless we have crossed some basic level of financial wealth, right? And then you start to look at some point of a time, any additional or incremental financial wealth is not going to make any difference to you, right? Small increases at an initial level, small increases in your wealth is going to increase your happiness. But as your financial wealth increases, you need bigger and bigger jumps in your financial wealth to give you additional amount of happiness, which I think we would have all seen as we progress in our own career. You start at a very basic job, you get a 5%, 10% increment, you're like, through the mood, you're like on cloud nine. You made another $10,000. 10 years, 20 years later, even $20,000 or $50,000 increment is not going to give you the same happiness. Right? Then you need something else. So I really like the whole book, and I shared my views. I thought I'll start with that, our discussion, because not everything is about money. At the end of the day, we are all here to build wealth so that we can sleep well. Right? I'm not the one who is trying to look at how can I make maximum money. I don't want to lose my sleep in trying to make maximum money, or lose your health in trying to make maximum money. Not really worth it. So hope if you get a hand on this book, I would highly recommend reading this book. Right? Little different than what stocks to buy or which mutual funds to invest in, but actually how to think about building wealth. I think those who are just starting their career or in an initial level, this could be really helpful to to just overall putting yourself in a level in which you think what else you need to do, what strategies and the tactics might be required to move from one level to another. Right? And in some cases also, if what are the things if you're not feeling happy, you know exactly what may be a reason, because additional some money is not going to make you happy. If you are not happy in level 3 or level 4, then the cause of your unhappiness is not money, it's something else. Maybe it's that's how you're born with, maybe that's your character, maybe staying little unhappy, it actually motivates you to do more. You treat it as a as a motivation to perform better. There are different ways in which people want to motivate you, motivate themselves. Some people will always say, "Oh no, something is lacking in my life," so that it keeps them on treadmill and keeps them always active to try to achieve something else. Right? So there are other people who will be happy in what they have. You know, at a level 3, level 4, I think everyone has enough to survive and lead a good life. But then it's not the money that will bring you happiness. If you're not happy in level 3 or 4, it's something else. So I really like the concepts in the book. Thought I'll share it in this meeting. I see some questions out here. Do you own Xpeng and how does it match? I mean, I do own. I own 3 Chinese auto companies, Xpeng Motors, Li Auto, and Neo. And small portion of my portfolio, uh, and I still like it. Look at it's a new car which they released. I think not. I get confused between the Neo models and the S-Pen models because both of them were really, really good. And I was watching a YouTube review of one of those models. You know, Tesla looks like a Camry versus BMW. If you look at some of these high-end Chinese EV cars from, let's say, Neo or Xpeng, which are actually cheaper than Teslas, but they are way, way better in terms of the luxury feel and how much of features they pack into the car. That's great. Any comments on Meishun? That's a food delivery. I don't own the stock, so I've never done a deep dive in it. But very recently, not very recently, maybe almost 12 months, 18 months, there has been an extreme competition in all the 4 big brands in China which are involved in delivering stuff, right? JD, Baba, PDD, and Meishun. There were also some regulations from Chinese government in terms of the anti-monopolistic policies that these companies had instituted earlier. Means if you're a driver for or a deliverer for one company, you cannot work for another one. So I think government is uh, government had earlier fined some of these companies for these practices and also had asked them to give a better wages, etc. So I don't own this because it's highly competitive. A lot of focus has been on local commerce in recent a month or maybe 6 months or so, like a quick delivery, quick commerce. And that's the reason why JD.com actually started to looking to go into brick and mortar commerce. They basically bought a company in Europe because there's too much of a competition coming from Alibaba, Meishun, and other these companies. So I don't, that's why I don't own it, because I don't know how big their moat can be if they're only in this one business. Ramesh is saying, or starting trading options, selling puts and calls. At the end of a day, the idea is to generate a business, and this is how you generate a cash flow while you own the great businesses. Where do you find businesses to buy? I mean, I find businesses to buy on the public stock market. right? I have access to financials and everything else. So I prefer to buy businesses which are trade on public markets, but there are ways you can also look at business if you want to buy private businesses, like then I guess you can search for. There are actually some folks have reached out to me many times that I can get access to or own some private businesses like laundromats or some dairy milk, and I'm like, I'm not interested in that. Uh, my preferred way to own businesses is through the ones that trade on public market. I want to buy a little bit of an equity. Owning a private business, more risk and then of execution, and then I want to own 20-30 businesses. I don't think I can own 20-30 operating businesses. I want to own a portion of this. So my method is through the public market. What else? Okay, no other questions, I guess. All right. So I want to go through the super investor moves. I think over the past few weeks that's we have done after the 13Fs came out. So I have one more to share with you, which I shared this week was looking at so now actually there are 4 fund managers that have also reported. I don't know how some of the fund managers actually get an exemption from SEC to report it little later. So now I have a data from 93. I think one more is yet to report. So overall I have a data for 94. But anyway, 89 gives you good sample size. So this is to look at how many of these so-called super investors, smart money, which stocks are they investing in China. So I looked at Alibaba, BK, Baidu, Bilibili, BYD, FXI, which is ETF, GDS is an education company, so on and so forth. You can look at, I don't want to read all the tickers here. Total amount invested is $9.4 billion across these 89 fund managers. Uh, this was surprising for me. PDD is by far was the leader, and this data is as of June 30th, 2025. So things could have changed. But PDD is by far the most amount of dollars invested by so-called smart money, with more than $6 billion out of $9 billion. And Alibaba was number 2, which is with 1.55. So PDD is like 4x Alibaba. And then I think this is TME, which is Tencent Music. But if you dig deeper, you see PDD, more than half is coming from just one investment fund manager, which is Baillie Gifford. We looked at all the other, Baillie Gifford's investments. So I am not surprised that Baillie Gifford basically, I mean, he always has his tentacles around all the e-commerce companies across the world. So I'm not surprised that he has the most one, but I don't own PDD. But that got me interested because I respect Baillie Gifford. And if they are in PDD, I need to see what their thesis is. And if I subscribe to that thesis, maybe I will own PDD. Right? Time will tell. Looking at who are the best, the top leaders, Baillie Gifford has the most invested in Chinese companies, majority coming from PDD, which is $3.6 billion. Then he's got in Tencent Music. Second is David Tepper from Appaloosa. And David, I think David has actually reduced. If I go back and look at its Q2, he had a lot more money in Q2. But I would say that's his biggest is Alibaba, followed by PDD, and then JD.com, and then a couple of ETFs, right? Third one is Tuan Yongping H&H International Investment, $400 million in Baba, and all $900 million in PDD, right? All others are Li Lu, whom Charlie Munger said that his personal wealth he'll only give to Li Lu, is number 4, and then so on and so forth on the Chinese companies investment. So If you want to understand what's happening in China, why are companies investing in, focus on these top 3 or 4. Go and read their shareholder letters. Go and read their investment thesis on why they are bullish on these companies. Don't go and read what Altimeter Capital, Brad Gusner. I mean, they already exited all their position. Or probably, no, they have not exited it. I think the position is so less that rounding off on 1 million doesn't show up anything. Don't go and read Guy Spear. Don't go and read, let's say, Howard Marks. They got a very small investment. I love Howard Marks. Don't get me wrong. He's a great investor. But if you want to read what's happening on China and why you should invest in China, go and read who are actually talking from their pockets. Right? People who vote from their pockets, not from their mouth. I like those fund managers. So I would rather go and read Belly Gifford, David Tepper, and John Yongping to see why they're investing in China. So that reminds me of other thing. Next book that I'm gonna start, let me share that, is this book, which is, let me bring that up. China's, it's the book name is Breakup, which is on China's quest to engineer the future. It's a, I think 300 pages book. So hopefully once I'm done with that, maybe I'll come and share my summary of how I share the wealth ladder. The reason why I want to read this book is it was recommended by one of the ex-VC, GP of Benchmark, Bill Gurley. I highly respect Bill Gurley, and he had recommended this book on his Twitter feed. So I thought if Bill is saying that go and read a book, I should better go and read that book. So that's my next book on my list is Breakneck. Basically, it's been written by the author. It's I think author works for Hoover Institution, or maybe used to work for Hoover Institution, but of Chinese origin. Parents migrated from China, and all he tries to do is how China is focused on winning the technological war, in how closely they study American businesses, American technocrats. We don't pay that much attention to China, which is sad. We should see what Chinese companies and engineers they are doing. A question from Asif. Are HFs, hedge funds, mostly short-term trend riding? Some are long-term, but is the general tilt towards short-term versus long-term? So I know some of them, for example, if you look at Steve Cohen, right, 0.72 asset management, they are like a day traders kind of a stuff. I don't pay much attention to that. I don't pay much attention to ARKK. I won't pay much attention to, there are a few other who I know that they are a short term. In the best thing to find out short term or long term is go and look at how much their overall position constitute. Right? If you see they got 1,000 positions, and that means that mostly on trying to trade in and out of businesses. So I'll go and look at it. The top 15 and 20 positions, and if I see those are like less than 1%, then I know they have no skin in the game. But so the idea is, if I look at this and I see, okay, the folks that are in this are these top 4, 5, I know that some of them are long-term holders. Then I do want to go and look at their investment thesis. So that's how I use this data. Let's say on a UNH, everyone is like talking about Warren Buffett invested in United Healthcare. It's like blown away out of proportion. But if I go and look at United Healthcare, it's like 0.69%. It doesn't move the needle for Warren Buffett. If I really want to look at United Healthcare investment thesis, I should go and read Dodge and Cox, because they have a much bigger percent of their portfolio and much bigger dollar amount than what Warren Buffett has. So looking at these across all the fund managers, that helps me to see whose thesis should I even look at. Right? So that's how you use this consolidated data across all 13Fs to figure. It's not a like, a pass to say, oh, if majority of fund manager are in this, I should buy it, but helps me in finding out, make a better decision on, should I need to go and deeper dive into it, or if I were to, whose letter should I read? That's how I use this. All right, so a quick look at the trade. Sorry, any other questions? Nope. All right, so quick look at the TradFi market. Equity side, we saw, I mean, this is nothing new. We talked about it last week also. We know that the Fed is going to cut rates on September, and that means some of the till date unloved sectors, companies that need financial help to survive, companies that have a little higher debt on their balance sheet. Now, with the rates coming down, they all will have done better. Like in small cap stocks have surged almost 8% in August. Right? And in small cap, when I say that means the companies that have generally are struggle for running the business, they generally have more debt on their balance sheet. Companies like Nvidia, Googles of the world, they don't need Fed funds rate. That doesn't impact them. They are huge cash flow generating companies. They don't know what to do with their cash. They have so much cash. The companies that get impacted by the Fed fund rates and which then percolate down our economy in terms of what the bank would charge them are the ones which are small caps. We see a lot of churn among them. Some of them will just go bankrupt because they can't survive. Companies that are at a very start of their company life cycle, either they are funded by venture capitalists, right, which now might be finding tough to raise another round, and hence we saw a lot of startups just died, or in after 2022 once the Fed start to raise the rates. Or if you're in a public market, then these are the small caps. Look at your Russell 3000, pick up the let's say the 70 lower percentile, or for all those companies. Those are the companies which mostly get impacted by the change in interest rate. And no surprise that the small caps are surged 7.5%, right, just in August. So autos, like look at the cars, CARZ, right, which is basically autos. And we all know auto is a high debt company. If you look at the overall balance sheet of automobile company, it's a hugely capital intensive business, right? Even if you're a Tesla fan, you've realized that you can't just download a car, or you can't just make a car by copying and pasting a code. You gotta have those. It's a hugely capital intensive. Cars, which is an ETF, have done pretty well. Look, from a start of an August, which may be around here, 62 to 67, pretty well. Similarly, other ones like airlines, looking at airlines ETF, again, have done pretty well in August. What else? Home builders, XHB, same story. Home builders, obviously, if the rates coming down, we expect that the mortgage rates will come down, hopefully. That didn't happen last year when the Fed cuts the rate, right? The last rate cut we got was in September 2024. We got 25 basis point rate cut, and the mortgage rates actually went higher. But our hope is, as an investors, we hope that we will eventually, the mortgage rates will also come down. That will give a boost to overall, home builder activity and economy. And I was actually talking to some of my friends yesterday. We were at a friend's place in a social gathering, and I on a Redfin, I'm getting like updates. What does notifications in that the houses in places like those who are from nearby Bay Area would understand these locations like Mountain House and Tracy. I get a notification that the houses are being sold at a lower price than what it is listed. So first of all, compared to last 3 years, the list price itself has come down. And now I'm seeing that even that lower list prices, those houses they're not able to sell the houses. Mortgage rates are so high. that the overall housing market has been very, very challenged. So if the Fed cuts the rates and eventually the 10-year come down, which will then impact the mortgage, in light of that, XHB real estate ETF will do good. And finally, look at your equal weighted S&P 500, which means this also considers have a much higher weightage of 493 Max 7 companies in its composition than what S&P 500 has. Much broader index. It hits its new 52-week high. So it does tell us that there's been a rotation that has started to happen from the only theme that had worked so far was AI, but with a lowering of interest rates, we do expect other segments to perform better, and market is starting to front run that, right? Market always runs a few months earlier before the economy. So that's one big thing I saw on the equity side. Then we also had a couple of earnings coming up. So the biggest company on the planet, the company that drives the stock market. Now it is Nvidia has got what, almost 8% of S&P 500. It doesn't happen always. I think some people are also very, very concerned about this concentration, but so far it's been working. So two companies that reported results, and I'll share those quickly with you. Nvidia was the first one. So let's look at what Nvidia had to say, right? Overall, I still love the result. Market probably did not like it that much because the stock sold off, after the results. So I think before the result, it was 180 plus, and then it had sold off. But come on, how greedy the market can be. Look at the results, right? Revenue is up almost 56%. It was a beat on the revenue, so beat on top line. Operating income is up 53%. So it's all coming from business, not much of a financial engineering. EPS up more than 60%. That was also beat. So you beat on top line, bottom line. Operating cash flow was up 44%. But I'm not much worried about that. It was quarter on quarter, it was down because they had to pay some taxes. But still beat on bottom line and top line. Guidance was good. And it does not include any sales in China, right? Look at the KPIs, data center revenue. This is what the market always focus on. It increased almost 56.5% to $41.1 billion. Market didn't like it. Why? Because I think market was expecting it to be 57%. So 56.4% now, come on, guys. Sometimes the market gets spoiled. Because if you go back and look at its year-over-year growth, and maybe let me just pull that, if I have that number, the data center revenue have been growing like triple digits, right? So if you grow from triple digits to now growing only 56%, you're not growing enough. Anyway, I think it was an overreaction. Other things really doesn't matter. Like gaming revenue was also up close to 50%, but who cares? All the valuation on Nvidia is based on the data center revenue. One thing which I liked on Nvidia was the networking revenue was up 100% year over year. So this is one area where they are, and the reason why I also track this is because you guys know I also own another company called Arista Network, new position that I initiated in portfolio in I think 2023 or maybe 2024. I don't think in 2025 I added any more stock to portfolio, but I like the company, and basically now both are competing in the same segment, which is AI networking, right? At the end of the day, doesn't matter how many GPUs have added, but if the GPUs are not able to, or either between GPU to GPU or between two servers, if the data communication, the networking, it becomes the bottleneck, then you could add another 10,000 GPU, is not gonna matter. So the AI, the network, there's been a lot of innovation happening on the networking side, where you connect either scale out, which means you connect within the same rack. How do you connect various GPUs together? Or when you're scale out, which means you are adding additional racks, etc. How do you do that connection? Arista have had some products in that. Nvidia bought a company called Mellanox a few years ago, and now they're using, Nvidia's got three technologies in that: InfiniBand, NVLink, and latest is the Spectrum X, which now competes with an Arista network. So I'm happy to see that revenue has grown up like 100%. I own both shares, so fine. Okay with whether it's Nvidia or whether it's Arista network. Great capital allocation. They returned $10 billion to shareholders. As a shareholder, I feel better. I don't even know why they're doing dividend. I think this is one decision which I don't like of Google as well as Meta, that they want to give a token dividend. It's immaterial. But why they want to give a dividend? It's actually not a prudent capital allocation decision, but this is to expand the type of funds that would start to own these companies. There are some funds which are dividend only funds, means they cannot invest in the companies that don't pay dividend, right? And if those funds, and if Nvidia doesn't pay dividend, Meta doesn't pay dividend, those funds will not be able to buy these companies, right? So these executive decided, we want to allow more and more. We want to basically have those funds as a shareholder. So let's give them dividend, right? It's absolutely, this should not be a reason to pay dividend. This is not how the CFO should think about their capital allocation decision. But when you're only thinking about how to increase the share price, who cares? Also, they had an approved additional $60 billion of share repurchase. I like share repurchase, which is fine because it is tax efficient. Dividends are not tax efficient. You get basically tax hit twice. Guidance revenue of $54 billion plus or minus 2%. And it does not include China in this. This was also a little lighter than what the market was expecting. I think market was expecting close to 55 or $54.5 billion. Little bit different, right? Not too much of a difference. And Jensen Huang was very clear that they have not considered any potential tailwind if, between China and US administration allows them to sell it. That's not even considered it. That could be another $3-4 billion, which will be another like 10% higher, right? From my perspective, I didn't see anything which is wrong in the business or in this one, just that you cannot have the same level of a growth percent when your base itself has become much bigger, right? It is foolish for us as an investor to expect that the data center revenue will continue to grow triple digits at a base which is like $41 billion, right? Now, having said that, the share has, already has run up nicely at the, from the start of the year. It's up 26%. So is there some breather? Sure. It might take some, in the short term, stocks prices run on mood and momentum. Now if we're thinking, oh my God, if I cannot get another 20%, maybe I don't want to be in the stock, right? There are some investors or / traders like these. You want to sell off? It's okay. It's not that it's available at a very cheap price. The stock trades at not too expensive like Palantir. You know my thoughts on that stock, but it's not as cheap as what you can get, in other companies also. So a little bit of that also is involved. It's not cheap stock, so might want to move your money to somewhere else if you think that the data center is not going to grow at triple digits. Also, Jensen Huang mentioned that, and again, he'll basically talk his book. By 2030, we're looking at another $3 to $5 trillion of spend in revamping the data centers. At the end of, in let's say next 5-10 years, all data centers will be AI data centers or GPU data centers. But of course, he's talking his own book. And we'll see. We'll see how it grows out. But I have no concerns on what happened on Nvidia. I have yet to go through the earning transcript. So maybe once I'm done with that, I'll see if there is anything else I find out. That's on Nvidia. Any questions on Nvidia earnings? Otherwise, I'll jump on to the next one. Any questions? That's good. All right. Moving on to the next one, which is okay. So let me give you a little bit more narrative. I think I had some charts. So as I talked about, as Nvidia's revenue is growing, so is its weightage in S&P 500. Now it's up to 8% weightage. So this is an exercise that you should do. If you own Nvidia and you own S&P 500, maybe you should look at overall what's your exposure to Nvidia, right? Or with respect to maximum, because now 8% of S&P 500 is Nvidia. So while you may think that your portfolio is very well diversified because you own S&P, that's like 70% of your portfolio is S&P, but that means almost 6% of your portfolio is Nvidia. It's becoming bigger and bigger part of S&P. Nvidia is up against the high bar, but the AI race is still on. The AI infrastructure demand still stays strong. We looked at the Google, all Amazon, Meta, Microsoft, and their capex. What we're looking close to $600 billion capex over the last 2 years. So huge capex is still going in AI. Also, AI investment was supporting US economy. If you look at the investment in computer hardware, shows 61%. And software was up 26%, which is the largest quarterly gain in 22 years. Right? Maybe some of them is front-loaded, possible, but it also is supporting, huge part of our economy. So there was another chart looking at a contribution of computer and peripheral equipments to US GDP. Right? When did we have this much? Way back here. So story is still high, but we have a lofty expectations. And that means because we have a lofty expectations, any weakness or any perceived weakness, let me say, not actual real weakness, any perceived weakness, you will see the stock market overreacting. Right? So that's what we saw. And Nvidia results were not bad by any means. There will be companies who will kill for getting the results that Nvidia is getting, but market reacting negatively because we have a much higher expectations from Nvidia. Right? Next one to look at is CrowdStrike. So any CrowdStrike investors here? Meanwhile, I see a question from Dave. Are you the owner of the business you own, or are you just an investor, meaning you own a portion of a company? I am, when I say business owner, I don't differentiate. If you own a stock, you own the portion of business. Or you better treat it at that seriously. So I'm a business owner because I own portion of Nvidia. Oh, wow, we got a lot of CrowdStrike owners. So this is the test you should do, and unfortunately, I think I was hearing, which investor was that? I forgot. So he was invited to speak in a conference, and he basically asked the audience, did a poll in an audience saying, how many of you are business owners? Like 6 hands went up. And then he asked, how many of you are stock owners? Like another 30 hands went up. Right? That was a problem. This is a problem that most of the people who invest in the stock markets have. at the end of the day, stock ownership is a ownership in the business, and you better treat like that. So the sooner I learn the lesson, I'm like, no, I own the business if I'm owning an individual stocks, and I better behave like that. I better track my business like that, right? It's not a, these lines that I own. It's actually real business behind it. That's what I own when I own a stock. Okay. AP game is rigged. Pelosi controls. I don't believe. Market is too big. All right, let's look at CrowdStrike. A lot of CrowdStrike owners. I thought you threw in 100K for each company. No. I have my own money that I invest in, right? And I invest in, do I have a more than 100K in one of these public companies? Sure. But I don't invest 100K in a private company. Or in a VC company, because K, he is a syndicate fund. That's not his own money. I don't know what he does now. I've not probably attended his session for last 2-3 years. But someone else's money, who cares? Like, mine is my own money. I'm very, very careful about how I deploy for the best results. CrowdStrike. So let's look at CrowdStrike. Again, I think so. CrowdStrike actually had a very interesting after market reaction, so we'll talk about it. But CrowdStrike revenue was up 20%, gross profit up 20%. Only big concern which I had was on operating income. Oh, sorry, and the margins, right? What happened to the margins and the income? Why your cost suddenly went high? So we'll talk about it. But growing at 20%, non-GAAP operating income had a new record for the quarter, $255 million. But when you look at a GAAP, it was pathetic. It was all negative. Operating income negative 112. EPS negative, net income negative. Why? Because of these three reasons. Stock-based compensation. If you recall, they had an outage in July 19, 2024, right? They did not have, their customers had, right? Delta had it. Many businesses just came to a standstill because there was a file that got without the best, the enough of a testing that went, and it had some incompatibility with Windows. If you're running a Windows operating system, and the systems went broke. So there is still repercussion from that outage because they had to give a lot of discount, what they term as a customer commitment packages. And the third was a strategic plan. So if you look at the report, the quarterly report, they'll say strategic plan charts. I'm like, what the heck is strategic plan? I want to dug further. I realized, okay, CrowdStrike actually had done some corporate restructuring, means laying off people, that they did in I think May timeframe. So there is additional one-time cost that they have to bear. Record free cash flow, record new ARR, and I didn't like anything which is like too bad in their business, right? Still, it's all fine. Want to focus on this thing in terms of how customers' adoption of various different modules within their Falcon platform, 6+ module, 7+ module, 8+ module, still healthy growth on it. But the stock fell down after the announcement that had happened, and then it went back up. It went back up. The stock fell down because of these negative margin numbers, but then it went back up because I think George Kurtz, the CEO, had said that they're expecting in the second half the ARR to grow 40% year-over-year. So it had an interesting move within after I think the release of the earnings report, and once the earnings call was there, and on the next day The stock was actually up. It opened up, higher. So interesting move on CrowdStrike. I do own CrowdStrike. I think I'll just keep the stock. I have no concern. Probably, I think I have a iron counter trade done on CrowdStrike. So that's on CrowdStrike. All right, I see one hand up. All right, Sam, you know the drill. I need to see your camera on. Sorry, I just want to avoid some bots here. Okay, all right. Good.
I just went to CrowdStrike 9 years ago at the first Wired, and it was not impressive. It was on 4th Street. Oh, 2nd Street.
So that was 9 years ago. I mean, this has become one of the best or the fastest growing cybersecurity company in, among all others. So I think when it came IPO, that was the first IPO that I reviewed, right? And so far it's been again, if you look at it, it's a lot of a growth being priced in. It's not cheap stock. And the numbers, if you look at the finances, the numbers perspective, not the best business that I own in my portfolio. And that's why it's not a big part of my portfolio, because it has to grow into this valuation. The operating margins are low, they're still diluting shareholders, etc. But the growth is great. So when you're trying to, at least when I try to structure my portfolio, if I'm only investing because of the future growth, and then I want to have a smaller portion, so what if it doesn't grow that much? Lena is asking, what about Palo Alto Networks? It's also a good company, but my only concern with Palo Alto Networks is they've been trying to move away from the legacy so-called firewall business to become a SaaS cybersecurity business. But if you go and look at how they've been trying to do, they've been trying to just acquire and kind of a bolt-on acquisitions. I'm not sure how successful they have been in that. Right? So almost all the growth is inorganic growth by acquiring companies. Whereas what I like more about the CrowdStrike is that they build their whole platform natively for SaaS. Palo Alto is trying to reinvent it itself to become more relevant in this new era. So that is one concern. Not to say that they cannot do it. They're great in their legacy business, what they have been doing it. And Nikesh Arora, he's a great CEO. Like, he was an ex-Google business officer, and then also was in SoftBank. So he's a great business guy. He's got all the good connections. That's why you do see him doing so many M&As. But so technology, sometimes you have to just build the platform, the base platform itself should be, I mean, how much can you twist and turn the platform to to, to change it to whatever the market is looking for? That's my concern. That's why I've not invested in Palo Alto Networks. Stock wise, I don't know. NW. Okay, not much. I mean, it's been trading sideways. Let's go and look at this. Last time we traded was in almost 18 months ago. It's back where it was 18 months ago. Again, without commenting on the stock, without looking at the stock price, that is what one concern I have with Palo Alto is they've been trying to change it their model by doing acquisitions. The question is, guys, can you grow organically? If you have any thesis on Rubrik, I've not looked at Rubrik because it was a recent IPO. I mean, again, these are product or a one product company, right? And Rubrik is more around recovery of a data. And again, Rajiv, you correct me if I'm wrong, but rubric is more around how quickly you're able to recover the data once, let's say, hack happens, etc. Right? And I think there are many companies operating in the same space. The X whatever the fire I got bought over by which company? I forgot. Is a part of now another company, right? Um, a lot of there are a lot of companies who are in similar adjacent space, and if rubric has only got one product and not an overall platform, then well, it could be gobbled up by another company. Again, I've not looked at rubric as a company or the financials, but obviously it's a new company that came to IPO maybe last year. So I want to maybe watch it for some more time. But I don't think even if a space opens up for another company in my portfolio, I would want to invest in I would want to invest in a company that is providing much more products slash becoming a platform than one product company. We have seen this with other companies like Confluent, etc. When they came IPO, become a darling of the market. By the end of the day, then you are just one product company. So that's my concern. Again, I've not looked at rubric as a company in terms of financials, etc. So looking at fear and greed index, we are still in the greed. So you can decide how you want to be in the market. When everyone is greedy, I want to be cautious. Right? Looking at the sector performance, S&P is still up like close to 10%. Not bad, guys. We're still fine. Doesn't matter what happened in last 2-3 days. We are still okay. Right? Even if you just own S&P 500, you're still close to 10%. Buys and sells, I did not do any stock buy or sell this week. So there's none to report. And looking at the portfolio, because this is the start of a new month, first session, after the stock exchange month has closed, this is how my portfolio looks like. Top 15. Nothing has changed from July and August except one. So Bitcoin had a week. I think someone had commented, right? Bitcoin, it was a weak week for Bitcoin, and that means ARKB slid out of top 15 and Palantir is back in top 15. Other than that, no change. I think Apple is back in top 10, but rest stays the same. I'll give you a couple of minutes to look into this. If you have any questions about the portfolio, top 15, ask. Otherwise, we'll show the pizza again in September or whatever the first session after the end of September, or maybe all October something. Missing Tesla. Tesla is not my top 15. I do own Tesla, but it's not top 15. Same stuff is Coupang. I own Coupang. It's not top 15. Palantir came back not because of Palantir, but because the ARKB slid down. I think that brought up Palantir. What is number 8? Line 8. That's Microsoft. Oh, I hope that's what you're asking. 8 is Microsoft. What do you think about recent run on BRKB? Thesis has not changed. So again, companies like BRKB is where the money will go in if they are a little jittery about the growth companies, right? Because those are the stable companies. BRKB, SCHD, stable, may not be growing like gangbusters, but those are the stable businesses, will continue to do fine. What or got to be unreasonably priced. So We saw money moving out of some of these high-flying tech companies and they moved into BRKB. I don't, week by week, month by month flow doesn't mean anything to me. Uh, some of these companies will, I mean, you will not realize the value of these companies unless we have a like season or a year like 2022. Then it's like maybe I should have had little more some stable companies in the portfolio. If you cannot withstand, let's say 40% drawdown, because some of the growth companies will go down not. AVGO, Google, I never owned Broadcom, but Google I do have in my portfolio, which is obviously sitting at number 5. Number 6 is cash. Yes. So remember, like last week I told I sold some ICSH. Then prior weeks I had some covered call assignments that I took, and I was okay to take that. So that did boost a little bit of cash in my portfolio. I'm waiting for VIX to go high. It barely went high to like up to 15 and a half and 16 on Friday. So I tried to sell a little more premium on Friday. Overall, I'm still at, I think, 24-25% of my buying power. I'm waiting for VIX to go higher so that I can deploy more capital, do a lot more option trades. Uh, but I'm waiting for market to basically give me better premium. VIX, where is VIX right now? I think it's 15-ish or something. See, look how depressed the VIX has been. 15.36. Right? It did jump higher on Friday. And I think I sold maybe close to $20,000 worth of premium on Friday. Not much. I think in some other weeks I've done much more over here. But yeah, I mean, I want to go out when I can get paid more, and otherwise we can be patient. So that's what I'm patient. I mean, have had enough decent gains for this year. I don't have to do any stupid mistakes. So I'm waiting. Happy with SCHD. Yeah, again, SCHD is not because I own it because it's paying dividend, but generally the companies that it owns, they do pay dividend because they are good businesses. They are the businesses, that in bad times will still not go as down as some of these growth businesses will go, right? Companies like when I say growth, I'm not talking about these Metas and Googles of the world, but one rung lower companies, right? C3 AIs of the world, Palantirs of the world, right? Shopify, etc. So, and of course, if we look at SCHD, right? It was actually up on Friday, while the rest of the market was down. It actually had a better week. But year to date, it hasn't done much. But that's okay. I don't have to beat any one particular year. But with this portfolio, I'm still handsomely beaten the SPY 500, so I don't have to be more greedy. Does Schwab allow Treasury money market fund to serve as cash collateral for selling puts? So I put in ICSH. So and it does consider it as a collateral. I mean, it doesn't consider it in your buying power. Right? So if I have cash, I'll just move it to ICSH. BRKB not high paying premium, no dividend either. BRKB doesn't pay dividend. I mean, they only paid once in the lifetime of BRKB, which is like some 50 cents or something. Only once. But when it comes to options, I don't know, because I'm not it's BRKB is sitting in my retirement account. So I don't actually trade on this one. Not too bad. I mean, they got a okay liquidity, not the highest one, but I've seen worse. But obviously you don't have, like triple digits IV or IV at 60, 70% on BRKB. So the amount of premium that you can get is depending on how the volatile the stock is, and the stock generally is not that volatile. So that's why you have less amount of premium than what you can get on others. But then you also have the risk. Anything else? Otherwise, we move on to I think next what, crypto? Oh, earnings. Oh, next week earnings, and then we look at crypto. Nope. All right, so let's move on to the next week's earnings. Neo, I will watch in terms of what's their, they had the new, what's the uptake of their family model, and they have a new line that they created. What else? It's going to be a little lighter week. I own DocuSign, but no, even Neo also. I mean, it's a house money, so yeah, it looks like it's going to be a very low engagement week from an earnings perspective. That means I can catch up on the transcripts and start on that new book in this week. What platform do you use for trading? I'm on Charles Schwab, so I use Thinkorswim. The other one is Tastyworks from Tasty Trade. Oh, that reminds me. By the way, next Friday, not Saturday, but Friday, anyone going to Tasty Trade event in San Francisco? I'll be attending that event on Friday. So Nyanka, it will be good to catch up. Maybe we can, after the event, we can go out for lunch or something. Who else? Anyone else going for Tasty Trade event? Come on, there are a lot of option traders out here. Aditya will go to LA. Okay, I'll spare you. Yeah. So I will be attending that. What event is that? Okay, so they do it at various locations. If you want to learn options, this is where I got all my options learning. I owe them a lot from an options learning perspective. So I just go to pay my respect and tuition fee, because they don't charge anything. You just watch them, and I learned everything. Most of my learning is from Taste to Trade. So yeah, 11 a.m. Event on 5th starts at 9. 2-hour event. You can sign up. These events are free. Tasty Trader, a good brokerage firm, not as good as Charles Schwab, because I cannot do, let's say, tax lot selection on platform, stuff like that. Sometimes I feel that I don't get the best fill, but like I said, I owe them a lot, so I still use them. But my majority of the portfolio is on Charles Schwab because of the tax lot selection and all that. So I'm not adding any more funds to Tastyworks, but yeah, I still want to pay them my tuition fee. Options commissions less. No, they charge $1 and no closing fee. I don't think options are cheaper. And then I think they also have, if you're doing too many contracts, they have a $10 as a max. Doesn't matter you do 50 contracts, but that doesn't imply, I have no use for that one. You were interested in Copart. I am still interested in Copart, but not at the price, at the valuation at which it is trading. CPRT. I mean, this is the company that I heard from Chris Meyer, the writer of a 100 Bagger book. And it does have a huge moat around it, but again, not at the valuation which is trading. Not interested from that perspective. I think I discovered probably, I will put in Copart when I'm looking to, move away from, let's say, anything that is to do with the AI. but the valuations are not that attractive yet. Any thoughts on the current state of both of these? So I don't own CRM. Broadcom probably, I want to look at Broadcom, but since Broadcom is running only right now its own AI, I don't want to add AI theme, a new stock on AI theme. That's why I stayed away from Broadcom. CRM has got its challenge in terms of what after Mark Benioff. Over the past few years, if you look at Mark Benioff and the leadership team that he's trying to build, nothing has stuck. They try different models, right? Co-CEO models, then that person left. Anyone who tries to move, I mean, whenever you move someone into a little more decision-making role, etc., people just don't stick to it. Slack, the CEO, founder of Slack, they also left. I'm a little concerned about the transition or who after Mark Benioff. Number two is getting very, very tough competition now from all these companies which are focused on agent, like ServiceNow, right? ServiceNow is moving into CRM space. CRM wants and Salesforce wants to get into ServiceNow space. I think Salesforce losing some of their edge because of these new AI agent. I know that's why Mark Benioff always talk about agent force, but we have yet to see the fruits of that. And the third is, again, lot of acquisitions. Lots and lots of acquisitions. Like the latest one is, which one they bought? The database analytics company, Informatica. Right? They've done tons and tons of acquisitions. So the question is, if you separate out the acquisition growth, you would say, how much are their existing businesses going? Is it just paying up for the revenue growth by acquiring the companies? Yeah, strategy could work, but that's not how you want to build your business long term. So yeah, that's the reason why I've not owned CRM. But Broadcom, I would say would be bullish on Broadcom because a lot of these companies will continue to find out ways to reduce dependence on Nvidia, and they will go to Broadcom for designing their ASICs. Tonya says, I'm multifamily investor. I do little investing in stock market. Multifamily, I feel less risky. Yeah, it's up to individual ones. I feel more risk on the real estate investing than on the stock market. So I stay away from investing in real estate. More risk in terms of the headache versus the return. I feel I have much better edge on the stock market than on the real estate market. So I focus on real estate. But again, it's an individual preference. So do what you think you have an edge. All right, looking at the crypto side of the house. Like someone was saying, we had a weak crypto market this week. So Bitcoin down from wherever it was, like last week when we had reviewed 118K or whatever to 108K. I think at some point of a time it was down to 107K. Same thing on Ethereum. Ethereum had a new all-time high, right? Of 4,900 on August 24. But then after that, it sold off. We are seeing some Bitcoin whale, some selling coming from Bitcoin whales. Maybe that could be a reason. Who knows? But still, it is tied to a little bit more of still considered as a little riskier investment, risk on. So this week we had a risk off. So we saw sale of other risky assets also. So crypto also sold off. Nothing new about it. But there are a few other things that happened. CFTC have decided that we should not block Americans from trading on foreign exchanges, but we would want to clarify the rules and regulations on if foreign exchanges want to take on American investor as a customers, what do they need to comply with? Right? Till date, for almost all of, let's say, new ICOs, etc., Americans were not allowed to invest because none of those companies wanted to invite the wrath of SEC. The regulations were not clear. Is ICO may be considered a security, then you may have to register with SEC. That's a huge long process. So those companies will like, okay, you know what? I'm not even inviting America-based investors. Let's sell it to the rest of the world. So if you want to invest in those, you did not have access to it, but new CFTC says we would want to actually tell you what the rules of the games would be. Other news was US government posts GDP data on blockchain in collaboration with Chainlink. I think this is more of more news than actually matters much. Doesn't really matter. Whether you post on a blockchain or wherever it is, the data that is being calculated is done by a centralized party. So who cares where it is posted? The data is not decentralized anyway. But it's a newsworthy item because the administration have already been saying we want to bring more transparency, we want to be crypto friendly. So now they can claim to be crypto friendly. But in the larger scheme of things around GDP number, it's immaterial. This was a little more exciting was Tether to launch USDT on Bitcoin. Because generally a lot of assets are being launched on the other platforms which have a smart contract capabilities. I've not seen much around on a Bitcoin. Of course, there's a Rootstock, and there've been some smaller projects that have happened in the past. But Tether is the biggest stablecoin issuer in the world, right? And now they have decided to do something on Bitcoin. Once I saw this news, I realized how are they going to do it? So it looks like in the recent upgrade of Bitcoin, they came up with some RGB protocol changes, which basically will allow you to issue you can actually issue digital assets natively on Bitcoin, right? So they're trying to use that ability. There was a news around Thailand considering Bitcoin reserve, and now these news outlet from which I picked the news are all crypto pro. So they will twist the news. But when you look into the detail, so a crypto influencer, Samson Mao, went and talked to an ex-prime minister of Thailand on why Thailand should have a Bitcoin strategic reserve. And now that get translated into a headline, say, Thailand considers Bitcoin reserve. Okay, that's not the case. So ignore it. So there is a push in Japan coming from the DPP party leader saying Japan should consider Bitcoin as a reserve, especially after you see the best performing company on Japanese exchange is a equivalent of strategy. Metaplanet is the best performing stock of I think 2024 and 2025. And all they do is what strategy does is buy Bitcoin as a treasury reserve. Maybe Japanese government is now saying maybe we should also do it, reduce some of our debt. They have the most debt to GDP ratio in the world anyway. And on the US side, applications for ETP continue to pour in. James Seifert, who does a lot of social work for those who are interested in crypto economy, his list has got 92 ETPs pending with SEC. And now you have everything, ETP for every sort, right? Bitcoin, Ethereum, XRP, Sui, Near, Bong, Melania, Trump, Solana, pick your poison. Right. So now issuers will issue anything that the investors were willing to put money in, or I should not say investors, maybe speculators and traders. So you got to be careful before you put money in any of these. Don't say SEC approved, it means it's investment worthy. SEC doesn't tell you what is investment worthy or not, right? So bunch of these EDBs are coming. So there's a huge lift. If you follow James Seifert, you'll see this, right? Hashtag says BTC. The basket means this, the ETP will hold multiple coins under it. The Litecoin, Solana, Doge, XRP, Cardano, Dera, Polkadot, Avalanche, Sui, so on. Pingu. Oh, there's a Pingu as well. I missed that one. These are meme coins. But come on, now we have, you can invest in meme coins, you can invest in anything else. And now we are getting, rates cut. So risk on, baby, risk on. So why not Pingu? Why not Penguin? Vinay say, what's the value prop? We'll talk about Ethereum. Right. So I'll cover that. There's a chatter lately about, yeah, this is what 90 plus ETFs are waiting for SEC approval. All right. Okay, the last topic on the crypto side, where's the link? I forgot to put the link. Anyway, so which is basically I wanted to cover Ethereum and give you some, is it Ethereum's movement? Right? What has changed? So that will probably give you some insight, Vinay, into what's the value prop. Okay, so let's talk about, is it Ethereum's moment? Right. Let me sip some water. Okay, question. How many of you are investor slash trader, or let me answer right. How many of you actually hold Ethereum either directly as a native Ethereum asset or through exposure through the Ethereum ETFs? Now we have an ETF on Ethereum. ETH, ETHA, or you have account in Coinbase, Kraken, and you own Ethereum as an asset. Aditya says, so I do own. So Aditya, anyone else? Rajiv says, sold off my Ethereum in a recent rally. Matt says Ethereum and BMNR. Bitcoin immersion, Pankaj, Ravi. Oh, come on. Maybe there's a lot of decent people here. Good. Okay, so let's talk about, is it Ethereum's moment? And the reason why I want to talk about it, because if you see, Ethereum recently hits its new all-time high, which is way after when the Bitcoin has done it. Now the question is there any more growth left in it, right? And what is driving all this stuff, right? So first of all, let's look at a higher level macro tailwinds. We had a spot ETF in mid of 2024, I think maybe around May, June, that time frame. We got a Bitcoin ETFs approved, spot ETFs approved in January 2024, but the Ethereum came a little later. But with that, there is a different investor also started to come in. I don't want to open an account in Coinbase. What if get hacked, right? I just want to buy the stuff which I can buy on my brokerage platform, right? Now you can buy it. So that was one tailwind. And then you see a lot of some of these fund managers, they cannot invest in a new asset class because crypto is a new asset class. ETF is an asset class that we are familiar with for decades, right? So that new money came in once the ETFs were there. This year, we also had a favorable legislation, right? Genius Act has become a law already. Clarity is still being debated. President Trump has said, given a deadline, that he wants to have this clarity also at his desk for signing before the year ends. So I don't know whether it will be done or not, but good to see that the administration is favorable. They already passed law around the Genius Act, which is also known as Stablecoin Act. And they're working on a Clarity Act, which was earlier known as Market Structure Bill, right? Which from my perspective is a lot more important. We are seeing stable coin. exploding, the usage of stable coin growing, especially now after the Genius Act. Now the companies know the rules of the game. Now they can play the game. Prior to that, we never had a clarity on, how to, if you're a stablecoin issuer, what you need to do, can you issue, not what you, only thing we got to know was you receive a letter from SEC saying you're being sued, right? That was regulation through enforcement. At least now the companies know and will be more favorable or inclined to play in this game because now the rules are clear. There's a thought around that this could become a global settlement layer, right? For the stuff like real world tokenization. Tokenization is becoming big and bigger discussion, not just when it comes to crypto, but even otherwise also, right? Look at what Robinhood tried to do. If you recall, there was a few weeks ago, there was a news on Robinhood that now you can buy OpenAI stocks, SpaceX stocks, tokenized version of those stocks on Robinhood platform, right? So there's been a push around tokenizing every kind of valuable asset, right? So that there is more liquidity created, there is more trading that could happen, better price discovery, and make it easier for every type of investors to basically invest in it. I cannot afford to buy a Monet or a Van Gogh painting. But if it is tokenized, maybe I'll be able to buy 0.00001% ownership in that painting. We have done it for the companies. And that process is called come to IPO, and then you tokenize the value of your company through those shares. That's nothing but you're tokenizing the business. You can tokenize real estate. I don't want to buy a real estate because it blocks a lot of liquidity, right? And I don't know if I were to buy one home, it costs $1 million. Let's say talking about Bay Area. But if I have a way to put in 50K in a home in Palo Alto, because the real estate, the ownership of the house has been tokenized, and then multiple owners can own a portion of it, maybe I'll be willing to put, right? So there's a lot of push towards tokenizing it, and if you use a crypto rails, it becomes much easier, much cheaper, and much quicker to do all your backend stuff, right? I mean, there's a push towards moving this whole our stock exchange also onto blockchain. We still have like T+1 settlement time. We moved from T+5 days to T+2 days, now T+1. On the crypto rails, you have instant settlement. Why have to wait for settlement after like 1 day? So, and the idea is if most of these projects around tokenization, they're all on Ethereum blockchain. So push coming from there, push coming from DeFi, right? Let's say once you have your identities, etc., also on a blockchain, then why not? I can take a loan by posting a tokenized collateral, right? Let's say if I were to post my house as a collateral because I want to take a HELOC or whatever, today you have to go through a big process. It takes a few days for bank to do it. But if I have everything tokenized, which means there's a provenance that and there's a guarantee that I really own it, and then I can go and use that to raise, on any DeFi platform, I can raise money. So there's a lot of and all those projects are again on Ethereum. So that's a lot of a favorable macro tailwinds behind Ethereum. What else? Institutional capital is coming, right? I hope we don't have any institutional investor in this group. We are all retail investors, but we were the first one. We were ahead of these institution guys because these guys had to wait for the ETFs to be available, we had a choice to go to Coinbase and buy Ethereum. But now the ETFs have been approved. We see a lot of institution capital flowing in. As of August, spot ETFs have almost $14 billion since their inception, which could sound big, $14 billion. But when it comes to Bitcoin, it is much lesser, right? But it's the second biggest one after Bitcoin. August, probably we got $4 billion net inflows, right? Institutional buyers, they're dominating the ETH exposure, right? Goldman has got and others. So now the narrative has been shifting, and I'll give you a couple of more slides around how the narrative has been shifting. From it being a degen assets, oh, only new kids are playing in crypto. No, it's it's up in the air. Who knows what you own? The narrative is now shifting from being a speculative asset to an investable asset. Not just investable, but you can also get a yield on it. And traditional investors love yield. You tell them that you're going to make 3%, 4%, they love it. And now that's the narrative shift that has happened, because ETH you can stake and earn yield on it. Finally, the big push also coming from DATs, which is basically digital asset treasury companies. It is what the strategy has done for Bitcoin, that I'm gonna just buy Bitcoin and hold on my balance sheet. Now, a lot of demand for Ethereum is also coming from these companies who are now following the similar strategy, saying we're gonna buy Ethereum and hold it on our balance sheet. Why not? If you're seeing, the whole idea why strategy want to buy the Bitcoin and hold it on their balance sheet is Bitcoin the value of Bitcoin is growing at CAGR of like 40%. And if I can borrow money at 9% and invest in an asset that is growing at a 40%, I'll do it all the time. That's what MicroStrategy does. Of course, there is a risk that you will get 2022 and the Bitcoin could fall down another 50%, who knows? But over last 16 years, 40% CAGR, pretty good, right? 40 or 60%, whatever the number is. Now, some of the institutions are saying maybe Ethereum will go through the similar trajectory. We want to hold Ethereum because there's a lot of use cases that we see on Ethereum. Usage of stablecoin across the world, real world tokenizations, DeFi, etc., which will increase the usage of Ethereum and hence the demand for Ethereum and hence the value, and I want to hold it on my balance sheet. There are some companies, Bitmain Immersion, BMNR, right? They pivoted themselves from being a crypto miner to forget mining. Too much risk in mining, can't make that much CAGR. I just will hold Ethereum on my balance sheet, right? Then there are other companies as well. The other one big notable companies is Sharpling Gaming, SBET. There are almost 70 companies now. Thing that to be cautious of here is there are just companies who are announcing this just because they know if they announce it, the stock price will jump. Right? So that risk is there. And yeah, so becoming an asset that companies are willing to hold on their balance sheet increases the demand for Ethereum. So that's one another use case, which is this I've seen happening only over last 4 or 5 months or so. Because maybe since February or March, this is pretty new stuff of rise of DATs, Ethereum DATs. Lastly, we have a new messiah for Ethereum, right? So when it comes to Bitcoin, we know the proponent is Michael Saylor. For Ethereum, there was no one who is a proponent for the Wall Street. The best proponent we had for Ethereum was Vitalik Buterin, but he's more of a techie person, right? He's so-called the founder of Ethereum. Tell me, if you're an institutional investor, who would you like to hear, Vitalik or Tom Lee? the answer. Now, Tom Lee also became a chairman of Bitcoin Immersion Technologies, BMNR. And now he's all over the media talking about like Ethereum is the next best thing after the sliced bread. So now we're gonna one new champion that institutional investors want to listen to. Tom Lee predicts Ethereum rally to whatever, 5,500 soon, 12,000 by year end. He's on all podcasts. The Mario Nafal, they are VCs in UAE and pretty good. Has run a lot of podcasts, and the space is on X, probably the biggest one with the most numbers of attendees. He got Tom Lee on his YouTube. ETH at 60K. I don't know what the year was, maybe 2030 or whatever. Who cares? I don't care about what are the price target, because Tom Lee has also given a price target of 10,000 Litecoin in 2020, the previous bull run, right? So who cares? But it's Tom Lee. That matters. The price target doesn't matter. What matters is Tom Lee. His face is splashed all over the traditional financial media. He's of all the analysts and the forecasters of Wall Street last 2 years or 3 years, he's been the most. And the TradFi idolizes Tom Lee. TradFi will stop their work and listen what Tom Lee has to say. And now he's saying these things about crypto. So that's why like Ethereum has been going up. He says next is the biggest macro trade for next 10 to 15 years. You can say he's talking his book, which is perfectly fine, because if you're holding, and I'm sure the Bitcoin immersion company would have given him some stock as a pipe investment or whatever. There are a lot of ways in which these treasury companies, which is like, I'm a little skeptical of many of the treasury companies, is they'll tie up with some of the earlier ways, convert into a stock, you don't pay taxes, and then you own the stock, you announce the stock goes higher, and then you can start selling have a capital gains tax, etc., instead of whatever. So there are some nefarious stuff also happens. But now we got the biggest bull of the Wall Street, Tom Lee, coming and talking about Ethereums. Right? Other players are also well respected. Joe Lubin, who is one of a co-founder of Ethereum, run the company called Consensus, which does a lot of work on Ethereum. Right? When I say a lot of work on Ethereum, is in advancing the ecosystem. So these are the techie guys. Right? Vitalik Buterin is more on an architect, giving the larger direction, and more of a putting the blueprint. Companies like Consensus, etc., who employ hundreds of engineers to actually create the dream that Vitalik has, or Ethereum Foundation has, right? And Sharplink Gaming, a gaming company, announced that they want to be Ethereum DAT and named him as a chairman. And then there are other players like Etherealize. In Ethereum, we never had someone who actually doing marketing for Ethereum. Don't tell me, for sure Vitalik can do it. That's not his DNA, right? But now then, Etherealize is a separate company, which is like a product marketing arm. If I were to give an equivalent of the stuff that happens at a traditional company, your product marketing division. So they work with Ethereum Foundation just to tell institutional investors about Ethereum, what it is, how it can be used, and how it's going to change the world, right? So this company was formed, I think, sometime maybe last year or earlier this year. So I listened to a few podcasts where the folks, these are ex-Wall Street folks, so they know how to speak Wall Street lingo. But I would say Tom Lee came the latest, like after all of them, and now Tom Lee is the biggest voice for now. Okay, so that's what's happening on Ethereum ecosystem. But let's focus. For as an investor, I also need to know, it's all hype, but what are the stuff that's also happening, right? So this is where I want to focus on. Hey, a few years ago, maybe 2023, I had shared in terms of the overall roadmap of Ethereum with the multiple upgrades coming, multiple levels of upgrades. These are the different phases: the merge, the surge, scourge, verse, purge, splurge. And I think I'd given you that time the why these are named like that and what kind of enhancements are going on. But if you look at it, we have been seeing some good protocol upgrades also. 2022, the merge happened from after the transition from proof of work to proof of stake. And then in 2022, the merge happened. Then we have a Shanghai or Capella upgrades, which enable the withdrawal of staked ETH, which was staked under the Beacon chain. Then the recent one, 2024, we had a Dencon upgrade, which means the main stuff was to scaling of a scaling of Ethereum blockchain. You had things like blobs were introduced for layer 2. Then very recently we had a Pactra upgrade in which you got account abstraction. I think I reviewed all these one of those weeks when it happened, right? A lot more EIPs came in. You got account abstraction, transaction batching. You can have stake more Ethereum, more than 32, and then increasing block capacity, etc., etc. Next upgrade coming is Fusaka upgrade, which is going to happen in November. Again, focused on scalability, etc. So there is work that is happening, but I don't think Wall Street pays any attention to any of this. These will be the table stakes. But even if you do all these things, but if there is no one to tell Wall Street how you can utilize Ethereum, this all becomes just a great techie projects. Now we have someone, Wall Street's own people, talking about it. That's why now I think maybe now it is Ethereum's moment. The upgrades upgrades have been happening over years. Still a lot more to go. But Ethereum Foundation, they don't do that great a job. And of course, Vitalik and Joe Lubin, if you are involved in that project, maybe they don't want to talk more about it. It's like I'm, beating my own drum. But now we have like a vast people talking about it. Maybe now the moment of Ethereum have come wherein we could see more and more interest. And Ethereum could be, see the time what, let's say, Bitcoin has seen over the last 4 or 5 years. Tom Lee, again, take it with a pinch of salt. He says that Ethereum is now at where Bitcoin was in 2019, because in 2019 is where we first introduced Bitcoin to the traditional institutions. So that's a bull case. What are the risks? Scaling. You can go and make everyone interested in Ethereum, but if the project doesn't scale, if we are still stuck at 7 blocks per minute, that's not going to happen, right? So we have seen that many of the projects are moved to different blockchains, right? Solana is the next most popular. Then there's Sui, Aptos found by ex Libra guys, and then there are different like projects which are addressing individual, I would say, limited problems like Celestia, Eigen. These are data availability layers, etc. But they're much faster. So, and I think maybe will exist both. Those projects that want much faster speed will move over to Solana. But those projects that want stability, guarantee that will never go down, and the fact that it is decentralized, could never be gamed, they will stay on to Ethereum. There could be use cases for both. Right? We'll see. Wall Street, I think, would not like to go and build their whole financial network on a platform like Solana, which has gone down 7 times in 6 years. But every year it will go down for whatever reason. Sometimes the sequencer will break stuff, and then a few of the validators get together and kind of a restart it. Guys, come on. If it is not decentralized enough, then maybe Wall Street may not want to put their money behind that project. But if you're building a meme coin, sure, who cares? It's not serious stuff anyway. So we are seeing these competing L1s. What else could go wrong? Ethereum ETF flows may be front loaded, right? And maybe the narrative will not work out. Maybe the rotation is only coming from some of those grayscale, etc. I don't think that is true because we got $14 billion. Right? So maybe everyone is trying to get in before others, and later on they'll say, you know what, we're done with it. This we already talked about multi-chain fragmentation, which is happening. Like we have stable coins are on. There are two kind of stable. One is most on Ethereum, which is for the Western market, like USDT, etc. Another one, the biggest one, is on Tron, which we don't talk about in Western world, which is the Tron is on Justin Sun's blockchain, right? And that's mostly being used in Africa to store as a dollar, as a stable coin, which is backed by a dollar. Maybe we'll have a multiple of these. If there is too much fragmentation, that could break down the thesis of the world global settlement layer, because then it will be, maybe it's a Western world settlement layer. And of course, the Ethereum dominance in DeFi NFT has eroded since we had other chains come in. Some macro headwinds. At the end of the day, these projects are still high risk projects, so you need more liquidity in the market for people to get excited and start buying Ethereum. If liquidity dries up, which I don't think may happen recently because we're looking at Fed to inject more liquidity. But what if the wheel turns backwards? That will not be good. And finally, the treasury asset risk. At one end, the treasury assets are tailwinds, but now if the declining MNAV, which is multiples or net asset value, which is what prompting all the treasury assets to basically buy Ethereum. The moment they buy these digital assets, the market will start to give. If you buy $100 of digital asset, market will increase your market cap of your company by 150. Right? They'll give you like 1.5 times MNAV. MNAV has been as high as 2.5 times, 3 times. I think Meta Planet of Japan has got the highest MNAV, even higher than strategy. But what if that MNAV start to contract? Then I won't invest in treasury asset. And then, these companies and DATs, and then they won't get the capital to buy the Ethereum. What if the MNAV start to decline, which is right now, the MNAV is on a going down right now. Now, because you got a DATs, which trade on normal exchanges, all the other Wall Street shenanigans can be applied on those companies. Someone can do hostile takeover of that. Tinfoil hat. Michael Saylor is big proponent of Bitcoin and only Bitcoin. He doesn't like any of the other things. He says all these things are shit. What if the MNAV on Ethereum that's decreased, let's say Bitcoin mining immersion, MNAV of that decreases? Michael Saylor could buy the majority stake, do a hostile takeover of Bitcoin, BMNR, and then force the company to sell off his Ethereum to buy Bitcoin. Because that will cause Ethereum price to drop and Bitcoin price to rise, which will help strategy. Now, these shenanigans are possible. I'm not saying he's going to do it, so don't quote me. But not just because it trades on exchange like any other company. You have to abide by the company law, saying if majority of the shareholders say that this is what they're gonna do it. They have a legally, they can fire the CEO and put in another CEO who will do what they want to do. Right? But if you're holding just Ethereum, then nobody has a stake in that, right? But if it's a company whose shares trade in open market, then anyone can buy those shares from the open market. So possible, these things could be possible, right? And finally, the bad fish could spoil the whole pond, right? We could have a crash like some of these DATs would crash, because I've seen DATs like a biotech company now becoming digital Ethereum digital asset company. Same in case in the Bitcoin also. But Bitcoin has got a one big strategy that is like so big than the rest of them that other companies will do any shenanigans that doesn't much impact, because you got a big anchor sitting in the strategy. In Ethereum, Bitcoin immersion could become an anchor, not there yet. Right? So if out of those 70, if like 40 companies turn out to be nefarious companies because they just wanted to announce this so that their share prices go high and never did anything, if that would crash the Ethereum price, it's going to also bring down the others like BMNR and all the other stuff. And so we could have that FTX moment of 2022 if we see a lot of these DATs just we have bad actors in these DATs. So these are the risks that I feel we should be aware of when we are looking into Ethereum as an investable asset. Okay. I guess that's it all I have. Yeah. Any other questions on Ethereum and why the market thinks that the moment of Ethereum has now arrived? I hope I answered your question. Vinay had a question, right? Value prop for Ethereum. Let me read some of the other comments. Okay, Bobby, what did Tom Lee achieve to trust his opinion? Since 2023, he's been saying it's a bull market. Whereas Mike Wilson, who the Wall Street idolized in 2022, he was saying it's a bear market. You know who won. Yeah, oh yeah, Neeraj already answered that, right? Exactly. Everyone who listened to Tom Lee made tons of money in last 2-3 years. Has Lee really made bad predictions? He made he did make some bad predictions. He told in 2023 that IWM, Russell 2000, will be a 50%. It was not. Because the idea was he thought the Fed is going to cut rates in 2023. We didn't get it. I think he had a similar prediction in 2024. We didn't get that one. So he's been bad on their IWM prediction, but over at a larger, he was okay. Because if you look at Tom Lee and look at his history, he's been mostly around the bullish side. What the markets have done over the last 15 years, maybe, take out a couple of years when we're bad, it's been bullish. So it's easy, if you're a bull, it is easy to be proven right over the last 15 years. I am not saying anything about future. I don't know what's going to happen in future. But over the last 15 years, yes, he's been proven right. Mike Wilson turned bull. Yeah, he turned bull very recently. And I think at some point of time we were discussing, is it a sign that we have achieved the top when the person who's been bearish for last 2 years finally threw in the towel and turned bull? Maybe that is that's the sign of a top. But we'll only get to know the top after we have descended from the top. Right? That's the fun part. All right, so that covers Ethereum. Now the last topic for the day, DoorDash. For another 30 minutes, DoorDash, then we break out into the breakout rooms. All right, any other questions? Shoot, otherwise I'll find where my DoorDash deck is. Vinay, everyone can be right given enough time. Yeah, even my neighbor's dog can be right. And a broken clock is right twice. So yeah, don't put all your money based on what Tom Lee says. My personal take on ETH, I think I'm bullish on ETH. but I still consider it as a moonshot. So if you look at my portfolio, I still have ETH marked as a in my barbell approach. It is a part of my moonshot portfolio. Today, I'm not today. Yesterday, I was thinking maybe to move Bitcoin to growth portfolio. But ETH is still a moonshot portfolio for me. Means it could become 10x in 10 years, or if it doesn't pan out, or we suddenly find like quantum is breaking everything. I mean, one of the upgrade which is being planned is for quantum resistant. But let's say, if this whole real world tokenization, nothing works out, it could go down to zero, sure. So size the portfolio accordingly. My personal take is I'm still bullish on Ethereum. So I have like short puts on ETH, ETHA, etc. All right, so let's look at DoorDash. Ravi is still there? So make sure that, okay, he's still here. All right, Ravi, that's you. So let's talk about DoorDash and investing thesis. I'll go through what I learned about DoorDash. I don't own this company in my portfolio. Of course, I looked at this company various points after it became IPO, but not in so much of a depth, which I did in my preparation for this meeting. Okay. So what does the company do? Hopefully it doesn't need any introduction, but a quick one. In any case, it basically delivers food and now trying to move into other ones. So basically it's a delivery company, started as a food delivery company. Tony Xu is a founder. I think I reviewed its IPO, and it's got a very inspiring, at the start of your S1 document, you'll have a letter from a founder, very inspiring letter. If you are a shareholder, you should definitely read that. Founded in 2013 by Tony, operates in almost 30 countries. It is the biggest player in food delivery business in US. I don't know about the share in China. I don't know that breakup. China, there are a lot of other competition, but in US, it is the biggest player. Okay, what's their business model? Basically, it operates a three-sided marketplace. On one side, you have a consumer. I don't want to cook. I don't have time to cook, or I don't know cooking. So I want someone to cook for me, which is where the merchants will come in, where the restaurants will come in. But then someone has to deliver that to me because I don't want to go and pick it up. I could, but I'm lazy. I want to watch the football game. So the dashers will come. It's a three-sided marketplace of consumers, merchants, or restaurants who can now expand their base. They can reach out to anyone or having access to internet and a DoorDash app. And then the dashers who are like, I can make some extra income on the side. Like college guys, I'm done with my college. I'm off after 3 p.m. Maybe I can deliver some evening meals, make some side income. Then you have these are the core stuff. Then you have adjacencies built on top of it in how you make money. Dash Pash, which is a subscription. You get some benefits to subscribe to it. They have a DoorDash storefront in which merchants can use it to upload their menu, etc., so that customers can then order from it. And DoorDash Drive for white label delivery. It won't be delivered from a DoorDash, but other delivery company can use the software. What's the roadmap? From a food delivery, which is how we know DoorDash, to become a deliver and a little local commerce. Local commerce means delivering everything locally in a short distances. Move into new verticals. They recently acquired a company called 7 Rooms, which is basically a hospitality software platform. So because they already have a relationship with the restaurants and all that, now they can actually sell the restaurant management software, which managing in-store dining, guest management, etc. to them. Explore other revenue streams like ad tech startup. To me, it looks like at the end of the day, if you have a consumer, you need to have your ad tech strategy. Right? We saw Uber going through the same evolution. Now DoorDash is also looking at maybe make money through selling ads. which is a very high margin business. And finally, expand to a new geographies through acquisitions. They already completed one acquisition, Volt, and the delivery is going through the review of authorities. Right? The sources of revenue, we talked about three-party marketplace. They charge commission to the merchants/restaurants whose goods are being displayed, are there. Then the customers pay delivery fee. And then you also have a subscription fee from Dash Pass or Volt Plus membership program, high margin advertising revenue, and then the SaaS revenue from products like DoorDash, Storefront, and 7 Rooms, etc. Right? So these are their revenue sources. This is how they make money. How big is the market? Online food delivery is like $300 billion, probably growing at 10% rate. US market, which is where DoorDash primary source is, they have like, I think, more than 90% revenue come from US. Now with an acquisitions, probably international revenue will expand more. But US market is relatively saturated. 2/3 of the users, DoorDash has already penetrated 2/3 of its target base. So the way to win the US market will be how I can extract more money from existing users. Maybe instead of delivering food, I will deliver grocery also. Who knows? Like, how do you get more from the wallet by becoming a bigger portion of local commerce? So that will be, determine, how much successful can DoorDash be. What's the moat in this business? Overall, I rate the moat as low because from a consumer perspective, it's a low moat business. As long as if my restaurant is on Uber Eats and DoorDash, I will order from wherever I can get the cheapest delivery and the fastest one. Zero loyalty to either DoorDash or to Uber. It's a transactional business. Once the food has come, I forget about DoorDash or Uber, right? So, but you could create a stickiness, which is what both DoorDash and Uber is trying to do, is through their membership model. Become my member, pay me a monthly membership fee. I'll give you 10% discount on food, maybe free delivery, whatever. Uber is trying to do the same thing with their Uber One membership. Merchants could be high to medium because there's an integration work involved to integrate with DoorDash platform. Dashers, low. I can deliver food. How does it matter whose food I'm picking? What's written on that on the receipt, whether it's from Uber or is it from a DoorDash or from any of the other food delivery? Like, I just need to pick the package, put it in my car and drive. So very low. So in the absence of a strong moat, only way to win the business is scale. Economies of scale. The bigger you are, then you can crush your opponents, can drive them out of the market, right? That's the only entry barrier they can put in. If there is no technological mode, there is no loyalty mode, there is no switching cost mode, there is no branding mode from a consumers and dashers, none of these exist. Only thing that exists will be scale, which will allow you to deliver your services cheaper. It becomes like a commodity. Right? I really don't care where I put my gas from. Right? It's the same 89 rated fuel. If there are 2 gas stations, who is selling me cheaper? I'll go and put that gas. Exactly, it's the same case here. There's a lot of competition, right? In different geographies and even in US also, right? US, which is 99% of the revenue, Dash is a leader, followed by Uber Eats and Grubhub. Now, Grubhub was taken away by Grubhub Just Eat Takeaway. Non-US, you got Delivery Hero, Just Eat Takeaway. Deliveroo was it, but now they're acquiring Deliveroo. Indirect competition, the restaurants also have their own delivery services like Domino's, or they can tie with stuff like Instacart, etc. So those are so it's a very fragmented one. But not surprised to see that acquisitions happening because scale is the name of game. And now Deliveroo would have realized that, come on, we can't survive with such a small scale. It's not possible to make money. And DoorDash knows that they need to grow and basically scale into, let's marry, right? Let's buy them. Maybe it will become oligopoly. Maybe there will be 2 or 3 players which will have the most of the market. How Dash do go-to marketing? They do direct consumer, Dash Pass subscription, partnership, but they have a high customer acquisition cost. So I think currently their lifetime value LTV to CAC is 1.75 or something. You should have 3x to become a sustainable business. So to reduce or to increase the lifetime value, they have to get more from existing customers. And hence we see these subscriptions, more verticals, Dash Pass, and all that stuff. And for merchant acquisition, increase the LTV for merchant acquisition, you have 7 rooms and other stuff. Looking at leadership, Tony Zhu has been around ever. He's the founder, still there. He worked in his mother's restaurant. That's his story of why he wanted to open this company. Andy Fang is co-founder, CTO. Stanley Tang, co-founder, head of DoorDash Labs. And Ravi, who was a VP Finance, promoted to CFO. More than the names, I'm interested in this next slide, which is skin in the game. Tony clearly has a skin in the game, almost 4%. Not that much from others, right? But 4% is big enough. It's a public company. If you're interested in this, keep an eye on these things. Gross order volume, monthly active users, LTV to CAC ratio, they don't give, but it should be growing and not coming down. Membership growth and numbers, net revenue margin, which is generally the take rate, right? And the contribution profits. Can you actually make money on incremental order, right? It means your fixed cost. I'm not considering a fixed cost, but if you can't make money on an incremental order, then you have a much bigger problem in long term. So looking at a KPIs, I'm okay. I think the marketplace is growing. MAUs are growing. Dash Pass members are looking good. Margins is a little low and contribution profit is less. So I want to see these things to grow. Now comes to the financial metrics. So far we never looked at them. Now look at really the numbers. What am I getting here? It's a low margin business. Shouldn't be surprised because the delivery business is generally low margin, high scale business. Revenue growth is good. It's been growing at like 24% last 1 year, 30% looking at 3-year CAGR. But margin sucks, 4% operating margin. Of course, they were negative operating margins during the earlier part of life. So they just turned positive. So really want to make sure that they stay in this. Right. So if you're not making operating income, how do you continue your operations? Either take on leverage, whichever look for their debt to equity ratio, they are not taking on leverage. But then you can dilute your shareholders, which is what they have done. Is shareholder dilution is 10%, 8%, 9%, 6% trailing 12 months. And it is not available cheap. It's still pretty expensive. Forward PE looking at 44. Ignore PE, looking at a sales, still it's like almost 9 times sales. So it's still pretty expensive. Don't be fooled by the free cash flow, which is $1.7 billion for last trailing 12 months. A lot of stuff has come from a stock-based compensation. And actually, real free cash flow would be $650 million only. So at a big picture side, what I'm finding it is here, it's a growth business, no doubt. It's a growth business. A lot of growth has been priced in. And if they can grow their scale, and they got a formidable competitor in Uber Eats, which has got other businesses also, other than just the food delivery. So they have to grow into that valuation. Looking at a quarterly looks fine. I have no doubt about a quarterly one, but quarter doesn't matter. What are the risks? You got a regulatory risk. Today, Dashers, the cost, if the Dashers need to be classified as employee, the cost will jump up. Competitive risk coming from Uber Eats. Macro stuff is if we have a recession, we will start cooking at home. We don't want to buy an expensive restaurant food, right? That will result in decline in total orders or marketplace gross order volume. And finally, execution. Will you be able to do the whole integrations of all the acquisitions that you're doing, and how you are able to do in a way that it will become accrual to your business, right? And you actually derive synergies from that acquisition. But if you think all CEOs do acquisition because there are always synergies, I have attended conference calls wherein the CFO told we had a dis-synergies from this and hence we're losing money. Why the heck you did acquisition, dude? Anyway, so I've heard dis-synergies word also. Now looking at a valuation, right? DoorDash market cap $104 billion at a last 12 months of $11 billion revenue, growing at this. This is Uber, P is 130, which is significantly higher, but average peer group average is 34. So it is pretty expensive company at this price point. So I went to do the reverse DCF, saying how much growth is actually priced in. If we were to consider from a free cash flow perspective, I'll grant them the benefit of doubt, saying, okay, SBC, I'll shut my eye and say, okay, whatever you claim as a free cash flow is actual free cash flow. So they need at least 23% of their free cash flow growth for next 10 years to justify their current price. But company is also diluting shareholder. If I consider dilution of 4%, then the free cash flow should grow at 28%. Can DoorDash do it? Very difficult. Not impossible. Not many companies are able to do this. So from a valuation perspective, I think it's pretty expensive trading at a current valuation. And given that the next few years, strongly competitive with a low moat business, growing your free cash flow at 28%, if you continue to dilute your shareholders, is an uphill battle. Right? But if you're interested in this, keep an eye on these three pillars. Profitability in US market, and habituation means how are they having customers use them more and more, so that they don't have to spend in acquisition of customers. It is becoming, first of all, the number of customers that you can acquire more is only 1/3. You already got 2/3 that know about DoorDash. Right? So, and you'll have to spend more and more to fend off against the competition. So, but if you already have a customer, how can you grow and have them put into their habit that they actually order continuously again and again from more frequent orders from DoorDash? Profitable international expansion. This is pretty new. We need to see if on the international side, are they expanding profitably or not? Because that would be the next growth engine. Growth in US, customer acquisition is not there. If they want more customers, go outside. Vertical, additional verticals that we just talked about, 7 rooms, trying to monetize their ad, etc. We need to see how good can they scale it. Ad business had $1 billion annual run rate, which is good because it's going to change their margin profile. It's a high margin business. So if that continues to grow, it's a good for DoorDash. So keep an eye on, these narratives and watch how business is doing in that case. For me, my take is it's a strength is the biggest player in the segment, but the segment is niche, but it is looking into expanding into others as well. We got a risk around low moat, a lot of competition and regulatory risk. I want to watch the profitability, advertising revenue, international expansion, 3 pillars that we talked about. But the stock is not trading at a price which will give me margin safety. So I am going to wait if and when, and of course, I'm going to wait along with the other things on my watch list. And it has to be better than all of them. But if you find that, oh, no, I think you don't have any other ones, this is what you want to go on. If I were in that place, I would either wait for better pricing or I will do at a lower price, use options to do a risk-defined trade, or maybe buy it at a cheaper price than where it is trading. So that's my overall view on DoorDash, is business, competition, what they're doing in the future, and at the end, if I were to invest my money, how I would go about it. I'm not telling you to do it. You do it what you feel is the best and what suits your investment profile. Could the share double? Yeah, if we're going to get free liquidity and, in the short term, markets run on mood and momentum. And if that momentum traders shift on Dash, sure, stock could double, who knows? But me personally, I don't invest based on what the market mood is, right? So I'm going to wait. So that concludes the DoorDash investing thesis right at 12:30. I'm happy to answer any questions. Otherwise, we break into different breakout rooms.